It's Brian Preston, the Money Guy.
All right, Brian, this is actually, man, I love having the I think I told you this last time. I can see Facebook in here too. This is a Facebook question from Fiona. Thank you for the great content. My question is, my husband has 2 Roth 401ks from previous employers, but now he's self-employed. What could be the best option for him to roll his accounts into? We're unsure about the differences in all the accounts we've heard of, and she listed some. Simple IRA, SEP IRA, solo 401k. He's 38, I'm 32. I'm just thinking for a self-employed person, it might be helpful for you, Brian, to kind of walk through the different, iteration of retirement accounts that happens. And then maybe let's close with how do you decide what to do with old retirement accounts? Or what's the process?
It's kind of a cool new world we live in. And I love this because Fiona, it's gotten so much easier than even when I started my self-employed journey back in the early 2000s, because there was a path that you went as a self-employed individual. First, you stopped on, we all know that traditional IRAs are out there for anybody. It doesn't matter if you have an employer plan or not. It's just the deductibility is impacted. And then whether you're choosing Roth versus traditional IRAs. But let's talk about self-employed specifically. The first stop, and this one's still a very valuable one, is the SEP IRA. Yep. Because the SEP IRA, typically you show up at your tax preparers or you're doing your own taxes on TurboTax or whatever you're using, and you're like, oh my goodness, the company actually made money this year. I got a tax bill. Is there a way that I can lower my taxes and essentially go back in time without finding a DeLorean that can go 88 miles per hour? And the answer is, it's called a SEP IRA. The SEP IRA is one of the few things where as long as it's either before the filing deadline in April, or even if you file an extension, you can go all the way out to October. You can actually go back in time and lower your taxable income from last year if your compensation is structured the appropriate way. That's the one disclaimer word I'll use because it's too complicated for just a Q&A show. But you can go back in time with a SEP IRA. That's great. But you're going to come to a point that then you hire employees. I mean, you're like, well, SEP IRAs are awesome, but if I'm giving myself 15% or 20% to the SEP IRA, I have to give that to all my employees too. And that gets really expensive for a brand new startup company. So in the past, you used to go simple IRAs because they were a good step over point before you got to 401ks because they were cheap. You could go set up a simple IRA.
And any big provider.
Any of the big providers, they didn't have all the annual testing and requirements. But then solo 401ks came about for people who don't have employees, and maybe it's just a husband and a spouse, or significant others are working together. Those came into being. But then also traditional 401ks got so cheap to do the annual administration. All these low-cost providers came online that was only $1,500 to $2,500 a year annual compliance costs, and the tax savings by doing a traditional 401k were there. That a lot of people don't do simple IRAs because realize the problem with simple IRAs. First of all, you can't have more than 100 employees. Now, look, I know that's
not a small
pretty big
business,
deal,
right?
But it's also you can't save as much into a simple IRA. Their salary deferral limits are significantly lower than they are with the 401ks, which are we're $20,000, around the $20,000 a year mark right now for those under 50. But there's a problem though with solo 401ks, and this gets back to Fiona's problem. She's got residual retirement plans her husband does that are sitting out there, and I think she's probably thinking, to simplify my life, why wouldn't I just consolidate it all over? The problem is if he doesn't have employees and he does it through a solo 401k, there's a big catch there that you need to pay attention to with solo 401ks, is that you get to skirt or not have to file 5500s and all the annual compliance on solo 401ks unless the plan is over $250,000 of assets. And that's something that sneaks up on a lot of self-employed people.
Especially when you start rolling stuff in, it can happen quickly.
If you start rolling assets in, you're going to blow your plan up pretty quickly, in a fast way. And you might, some of those, instead of having years to do salary deferrals to build up to that $250,000 or $250,000, you reach it very quickly. Those are the things I would take into account because, and I'd also go look at the 2 Roth 401ks that your the former employers, were they Fortune 500 companies that had like a Fidelity, a Charles Schwab, or a Vanguard retirement plan
with a special thing like maybe a brokerage link or a PCRA type
you
option.
might have some great planning opportunities at those old plans, but there's also an equal chance that they could be a 401k that was set up by your old former, your husband's former boss's golf buddy
yeah,
or a college roommate
plan.
or a nephew that, is trying to make it in the financial world. And so they've sold a horrible retirement plan with high costs and big commissions. Pay attention to those type of things. Bo, I went so many different directions.
No.
Did you want to bring back that spaghetti and turn it into anything?
No, I think it was great. I think you did a really good job. I do think you said something to start with. It gets a little bit easier. Or it's easier today than perhaps it was in the past. But you want to make this decision well. This is one of those times where it's not a crazy idea to get a second opinion. It's not a crazy idea to think about talking with a professional to make sure that you're opening up the right type of account. I mean, people often solo 401ks and SEP IRAs are kind of somewhat interchangeable a little bit, but there are some unique and distinct benefits to each one of them, right? Like solo 401k at lower income levels, you can save more money because there's 2 different components. At higher income levels, they're somewhat equivalent, but SEP IRAs, I think you said this, will prevent you from doing other strategies like backdoor Roths and that sort of thing. So you just want to make sure that when you do decide to implement a retirement plan as a self-employed individual, you're just thinking through all of the consequences, intended or unintended, to make sure that you're making a wise decision.
That's a great point. Way to bring it back, because there were so many nuanced points there with what you could do with your retirement plans.